Wall Street is fixated on the Strait of Hormuz, bracing for a $200 oil spike that may never fully arrive. But while the cameras stayed locked on warships and headlines, a massive investment opportunity was quietly taking shape right next door. Saudi Arabia flipped a switch on a 1,200-kilometer pipeline, cutting straight across the desert to the Red Sea. Some call it Petroline. Most people missed it entirely. That sounds like a safe alternative. It isn't. The danger didn't disappear. It only moved to another risky location and created a bottleneck in the process. Hormuz normally handles around 20 million barrels a day. The east-west pipeline, running at full capacity, moves about 7 million. This isn't a clean escape route. It's a hardened bypass under pressure. And that changes the map in ways investors cannot afford to ignore. Markets don't price oil on fear alone. They price it on flow, what can move, what can't, and what gets disrupted next. When one giant exit narrows to a single substitute, you don't get relief. You get a bottleneck with a toll booth. So what does that mean for you? In the next few minutes, I'll break down exactly what investment opportunity this pipeline is creating, and the 3 tickers that could let you profit before the rest of the market catches up. Here's the problem. The east-west pipeline is real, and it matters, but it's nowhere near big enough to replace what the Strait of Hormuz normally carries. Hormuz moves around 20 million barrels a day. The east-west pipeline, at full capacity, handles about 7 million. And Aramco, Saudi Arabia's state oil giant, produces up to 12 million barrels a day at its peak. So even if Saudi Arabia can pump the barrels, it cannot reroute all of them through a single desert artery. That's the part most investors are missing. The bottleneck isn't oil production anymore, it's transport capacity. The kingdom is trying to force a supertanker-sized problem through a much narrower pipe, with almost no room to spare. That creates scarcity in the export system, and scarcity is what keeps oil prices elevated. For Saudi Arabia, that matters enormously. IMF-linked analysis shows that every additional million barrels per day can improve the kingdom's fiscal balance by 3.2% of GDP. The math is clear, and so is the conclusion. This pipeline is valuable precisely because it isn't enough. So if the pipeline helped Saudi oil escape the Gulf, does that mean the danger is over? Not even close. All it did was move the pressure west. The moment Saudi Arabia leaned on the east-west pipeline, the Red Sea stopped being a side route and became the new center of gravity. The barrels may have bypassed Hormuz, but they still have to survive the next leg of the journey, and that next leg was already under stress. Even before Hormuz became a flashpoint, the Red Sea was a live risk zone. The Houthis have been targeting ships for months, threatening one of the world's most critical trade corridors. The numbers tell the story. Vessel traffic through Bab el-Mandeb dropped by roughly 75%. Tanker routes stretched by around 38%. Shipping costs surged between 300% and 350%. A pipeline doesn't finish the job. Oil still has to reach terminals, get loaded onto tankers, and move through waters that insurers and shipping firms can still tolerate. The crisis was never removed. It was relocated. The Red Sea isn't the safe side of this story. It's the new pressure point, and that's exactly what investors need to understand going into the next chapter. Here's where this story stops being theoretical and starts becoming tradable. The east-west pipeline ends in Yanbu, a major Saudi port city on the Red Sea, and the final destination of every barrel that bypassed the Strait of Hormuz. The pipeline itself gets all the attention, but the real question is what happens at the endpoint. Can crude reach Yanbu, get processed, get loaded, and keep moving without a major disruption? Right now, that answer is far from certain. Recent reports indicate the Yanbu terminal was struck by a drone in March 2026. The Samref refinery, also located in Yanbu, was reportedly evacuated following Iranian warnings and drone threats. The bypass route doesn't end in safety. It ends in a live threat environment. That changes the investor logic completely. Stop asking only which companies benefit from higher oil prices. Ask which companies benefit because Yanbu has become too important to fail. When an entire bypass system converges on a single endpoint, that endpoint becomes a strategic asset with a target on its back. And that gives you 3 distinct investable layers: national resilience, endpoint processing, and infrastructure protection. This is where the story becomes a market opportunity. The first ticker in this framework is KSA, the iShares MSCI Saudi Arabia ETF, and it's the broadest way to play the Saudi side of this story without having to buy local shares directly. That matters more than it sounds. Most US investors can't easily purchase Saudi stocks one by one. KSA solves that problem through a standard brokerage account. It trades on NYSE Arca, and as of late March 2026, it held around $715 million in net assets. But here's the key shift. This is not just an Aramco trade. KSA gives you exposure to the wider Saudi market, financials, domestic sectors, the entire ecosystem that benefits when the kingdom is forced to spend more, to harden infrastructure, to stabilize the system, to keep Vision 2030 on track. Here's the logic. If Saudi Arabia has to defend, fund, and adapt around a rerouted export map, broad Saudi assets reprice with it. For regular investors, KSA is the cleanest first entry into the Saudi resilience story. The second ticker is XOM, ExxonMobil. But don't think of Exxon here as just another giant oil producer. In this story, Exxon is the endpoint processing trade. Here's why. Exxon is directly tied to Samref, the refinery in Yanbu, right at the Red Sea endpoint, where this entire rerouted system has to prove it can still function. And when transport gets harder, the assets sitting at the endpoint become more strategically valuable. Here's the profit link. When bypass capacity is scarce, the barrels that actually reach Yanbu matter more. Companies tied to refining those barrels can capture more economic value, turning crude into higher value fuels and chemicals before export. That translates directly into stronger earnings and higher pricing power for Exxon's endpoint assets. Put simply, if Yanbu becomes more critical, Exxon's position there becomes more profitable and more strategically important at the same time. That's why XOM fits this thesis. The third ticker is NOC, Northrop Grumman. Don't think of NOC as a generic defense stock or a simple bet on war. In this story, Northrop is the infrastructure protection trade. Here's the logic. Once the East-West pipeline becomes Saudi Arabia's primary bypass, and once Yanbu becomes the exposed endpoint, protection stops being optional. It becomes part of the operating system. If drones and missile threats can shut down the route, then air defense, radar, and command systems become part of what keeps oil flowing, and Saudi Arabia already spends at that scale. Its 2025 defense budget stood at around $78 billion, roughly 21% of total government spending and about 7.1% of GDP. Now, Northrop isn't the only company that could benefit here, but NOC fits this thesis because it gives investors direct exposure to exactly the kind of missile defense and infrastructure protection systems this route would require. NOC is the defense proxy for keeping the bypass alive. Here's the final takeaway. Saudi Arabia didn't find a perfect replacement for the Strait of Hormuz. It found an emergency workaround, and that difference is everything. The East-West pipeline keeps part of the system alive, but it also forces more value, more pressure, and more risk into one narrower chain. That's why these three stocks aren't random ideas. They're three ways to play the same shift. KSA is the broad Saudi resilience trade. XOM is the endpoint processing trade. NOC is the protection proxy. 3 tickers, 1 bottleneck, 3 ways to profit. One final word of caution. This thesis breaks if Hormuz reopens quickly, Red Sea shipping normalizes, Saudi political support weakens, or oil prices collapse. Keep that in mind before you act. If you found value in this episode, like and subscribe for more deep dive market briefings, geopolitics, macro shifts, and the hidden stock plays Wall Street keeps missing. Drop a comment below with a topic you want covered next. It helps us know what to build next, and it helps this video reach more people. Your support means everything. See you in the next one.